In this video, I will talk about 3 reasons why NIO may possibly not need to tap the markets for capital again and dilute shareholders. I see comments frequently, mostly by retail investors, that are freaking out about the fact that NIO is raising capital in the markets or that new dilution is on the way. Sometimes it's about employee stock options, sometimes it's about raising new funds straight with offerings, and so on, discussing how many shares are outstanding, how many times NIO has raised in the past. So before I dive into the 3 reasons why I think it may not be necessary in the future, just some general remarks. First of all, investing in startups that are unprofitable usually means that, first of all, there's obviously risk involved. Second of all, the startup may not succeed. And third, and that is coming back to this reason and argument here, startups need to tap markets in order to fund their growth. So if you're investing in some sort of business like NIO, but many others out there who are tapping the markets in order to fund their growth, then it should be assumed that this is part of the whole way to breaking even at some point. The reason why I don't freak out about this is that I think it's very usual and normal for startups. That's exactly why they go to the markets, and also the fact that they are incentivizing employees with stock options in order to have them profit from future returns with a small share that they get of the company instead of getting higher salary. I think that is actually a good thing in the structure of how these businesses operate. But I don't want to sugarcoat this and say it's perfect if a startup just goes to the market and keeps on diluting its shares, and in the end the value is going down. So certainly I have been critical here on this channel about the way the Abu Dhabi deal has been made, right? And I think we've now finally seen the consequences with the CFO taking his head and moving away, because I think somebody in his position or the whole management team was responsible for this deal coming too late at a too low value. We're now in a situation which is not great, that the NIO stock value is depressed as hell, and it's difficult for the company to tap into markets. That's exactly why we see the short sellers pressing down on NIO with 200 million shares short the company, because they're basically betting on the fact that the company will not reach profitability and they need to tap markets again. And if that's gonna happen at an increasingly lower valuation, that will be very, very bad, right? So yes, I was also not happy how this was done in a way that they didn't anticipate it earlier and raised at higher valuations, and the big amount that they raised without communicating the strategic aspect of that. But now let's turn to the positives. So I think there might be reasons why NIO may not need new capital in the future if the plans go along. But even in the case that they have to need to raise no new capital, the number 1 reason why I think they may not need to tap the markets is that they have now a setup with the new Abu Dhabi investors that is benefiting them and could help them tap into new funding. How is this working? There is a kind of obscure company at the moment. It's called 47. It's a UK entity that has been venture-backed also by the same investors that have now gathered this 20% stake in NIO, the Abu Dhabi investors. And it's an independent company. They're hiring new staff and they're doing some secretive work in order to, it looks like, launching a new EV brand in the very high premium segment with some British design roots. So that's all we know right now. The reason why it matters for us is that they are licensing NIO's technology for it. So that has been published a while ago, and they said basically that they are gonna pay NIO for getting the platform, technology, R&D work, and so on. And so far, we haven't seen these payments turning up in the NIO balance sheet. There might be similar deals in the industry where you can look at, and usually that's done also by the sales volume and even more. But the fact that these investors in both of these ventures are the same person or the same people behind it, it basically allows them to use 4/7 to pump money into NIO if they want to. And that's going to be high margin revenues that are basically coming straight in without needing to further dilute NIO. So let's say NIO needs $1 billion. Could 4/7 come up with a $1 billion payment for NIO to license its technology and have some future deals? They certainly could. I mean, they just need to make the plans, what they're going to do with the technology later on, and they pay NIO a fee. It's on a balance sheet, it's straight revenue, it's 100% margin, no need to tap into new funding. Why would they do that? Well, because it doesn't dilute their current stake in NIO, and it maybe even help the share price. So that's one quick way of helping NIO out from the initial investors currently, and it's a win-win possibly for both companies. We'll have to see what they're planning to do. It's just a theoretical thing. I might be wrong on that, but that's just how I'm reading into it, that this might be one possibility of getting cash if they need to in the future by the existing investors through this sort of a vehicle. The second one, I think we've already seen, which is that they can tap into their existing business and raise money in China. And you would think that this is sort of dilutive as well. So we've seen it with the example of NIO Power, which has just raised new capital in China. So NIO as an entity is a holding company under which you have several different entities, and some of them are in China. One of them is NIO Power. And they just went to local investors and have raised, well, I almost forgot the amount. I think it was around 100 million. And I also have not the numbers ready for the exact valuation, but I think it was more than 1 billion or 1.4 billion, because in the last earnings report, we saw actually how much equity they gave away. And why this might not be dilutive is simply the fact that currently NIO as a stock does not imply the goodwill or valuation for businesses like NIO Power, right? NIO is just trading at one-time sales or even lower than that, ridiculous valuation. So if they just go to the market in terms of the local market in China and get a local investor on board, and they get a certain stake of NIO Power and therefore helps to finance the NIO Power operations locally, that's fresh money. But the stock price won't move on that because the US investors, they just don't even understand it, and they don't even, price it into the company because it's not priced in either way. So there's currently the Chinese investor willing to value NIO Power at 1.4 billion. And it's currently not valued in the ADRs in the US company at all. So it's actually a smart way to say, good, if you guys don't give any value to our stock in the company, then we're gonna give some of these assets to some investors who actually like to pay for it at some valuation that is currently not priced in the US ADR. In this way, we get fresh money, but our share count doesn't go up in the US ADRs. So these are two very feasible ways of getting new money without even having to tap into markets, without diluting shares, without even taking on new debt on the balance sheet. And the result is that NIO can fund more operations, more growth, more R&D. Now, the next way is the very obvious way. Well, first, I should say maybe there's even another half way of doing the same thing as the number one option that I mentioned, which is, this 4/7 deal. The NIO battery swapping partnerships are going in the same direction in the sense that they are forming an alliance there, and they are possibly getting paid on some sort of licenses, royalties or something, or R&D work at some point in time. But obviously it's not the same party, right? These are external companies, these are third parties, and we haven't heard anything about the monetary implications of these partnerships and deals. So it's just not a way of how they could obviously make new revenue streams, but it's not exactly the same way as this 4-7 deal, which is basically to the benefit of those Abu Dhabi investors, right? But we could also expect some nice goodwill or fees coming directly from those partnerships, but that's possibly taking more times. Anyways, obviously the third way of getting profitable would be just to operations, improving the net income and so on, and growing the revenues and becoming more profitable on both vehicle margins and gross margins and so on. And I think currently there is a realistic trajectory that we might break even in 2026 and still have around $3 billion in cash left. That's at least my business case scenario that I think is the baseline that I'm currently shared in my Patreon community, which is my personal take on that. I mean, I could be wrong, don't trade on that. This is my views why I am investing in the company, because I assume that even without having still these other opportunities that I mentioned to tap new funds, I think already they might be on a trajectory to break even with the current cash that they have and with the current trajectory that they're in. But that, of course, could change very quickly. We might see new plans, more investment, who knows? We might see deteriorating sales. We might see a black swan event. Who knows? Things can fail very, very quickly. And in that scenario, NIO would need to get fresh funds. And I think the number 1 and number 2 options are quite realistic, that they might be tapped in the future if there's a need for it. And it may not even be dilutive. So let me hear your comments, what you think about that in the comments section. Thanks for watching, and see you in my next videos.